Welcome to the Deep Dive, the shortcut to being well-informed. Today, we're taking on a really massive and often kind of invisible market.
Yeah, the movement of money across international borders.
Exactly. So if you've ever had to send funds to family or maybe pay a contractor overseas, you face this really basic choice, don't you?
You do. You have to decide, do you stick with the old, established, but frankly slow and costly system of a wire transfer?
Or do you jump into the new world? The disruptive, fast, but also, let's be honest, pretty complex world of cryptocurrency.
And this deep dive is all about that choice because it comes with some major trade-offs. We're going to be comparing the predictability of a bank to, the immediate settlement you get on a blockchain.
It's convenience versus cost, security versus speed.
The goal here is to give you the data, the framework, so you can decide which method really serves your specific needs.
Okay, so we're not going to bury the lead here.
Yeah.
Based on all our source material, the tension is pretty clear. If you prioritize absolute safety, traceability, institutional backing, you're probably sticking with a traditional wire.
But if what you really value is speed and you want to minimize fees and you're okay with a bit of a learning curve,
Then stablecoins are, well, they're quickly becoming the better tool. So let's unpack just how big this whole decision is.
yeah.
To really get why this choice matters so much, we have to talk about the scale of the global remittance market.
It's staggering. We're not talking about rounding errors in the global economy.
Not at all. The flow of money to what we call low and middle income countries, or LMICs, is set to hit something like $685 billion in 2024.
And the projections show that number could almost double. We're talking over 1.3 trillion by 2032.
That's a huge number. But what makes it really striking is when you compare it to other financial flows, right?
Exactly. You have to put it in context. So think about official development assistance, ODA, that's basically foreign aid. That was about $223.7 billion. Then you have foreign direct investment, or FDI. That's foreign companies investing in those economies. That came in at about $486 billion.
So wait, let me get this straight, if I'm doing the math right. The money sent home by individuals, these remittances, it's actually bigger than the foreign aid and the corporate investment combined.
Precisely. The flow of these, relatively small, frequent transfers sent by migrants to their families, that is the single most important source of external finance for these countries.
That just reframes the whole picture. It means these individual transfers are doing the real heavy lifting for an entire economy.
They absolutely are. This money directly supports education, healthcare, housing. We've seen studies that show a 10% increase in these inflows can lead to a 3.5% drop in poverty rates.
Wow.
And this money is often more reliable than, say, volatile corporate investments. You see places like Tajikistan, where remittances make up 51% of their entire GDP.
51%.
Or Tonga at 44%. For these nations, the efficiency of that money movement is, and this isn't an exaggeration, a matter of economic survival.
Okay, so let's get into the weeds of the established system then. The wire transfer.
The old way.
Yeah. When you go to your bank and you start a transfer, it feels simple on your end. But behind the scenes, it's this incredibly frustrating game of international financial telephone.
That is the perfect analogy. The whole reason it's so slow and expensive is because of all the middlemen.
Layers upon layers.
An international wire has to go from the sender's bank through a domestic clearinghouse, then to one or maybe even more correspondent banks, and then finally to the recipient's bank.
And these correspondent banks exist just because, my bank in the U.S. doesn't have a direct line to some smaller bank in, say, rural India.
Exactly. No single bank has a direct relationship with every other bank in the world.
And every single one of those checkpoints adds friction, it adds time, and crucially, it adds a fee.
Right. You're waiting for currency conversions, security checks, regulatory stuff at each stop. And that's why it takes 3 to 5 business days.
And that's a best-case scenario, assuming you didn't miss the afternoon cutoff time when you sent it.
Oh yeah, if you miss that, your money just sits there until the next business day. It is definitely not a 247 system.
And all that inefficiency comes at a really steep price.
It does. The average global cost for these services was sitting at about 6.49% in early 2025.
Which is more than double the UN's goal, isn't it? They want to get it down to 3%.
More than double. And think about what that actually means. For a family that's relying on a $500 monthly transfer, losing 6.5%, that's over $30. Money that could have been food or medicine.
Now, the banks are famous for double dipping on fees.
Oh, they are. Your bank will charge you, say, $25 to $45 just to send it. Then the recipient's bank often takes another cut just for receiving it. Our sources say that using a bank can cost, on average, a staggering 12.09%.
12%, that's brutal. But we do have to mention the cash-based services like Western Union. They're essential for people without bank accounts.
Absolutely. Western Union has over 500,000 locations. For the 1.4 billion unbanked adults in the world, cash to cash is sometimes the only option.
And sometimes they can be cheaper,
They
right?
can be. Sending $500 through a cash agent might only cost you an $8 fee, so 1.6%. But even then, you're tied to their business hours, their specific locations, and their infrastructure.
So this brings us to the crypto alternative, which is just. It's fundamentally different. It strips out that whole correspondent banking layer.
That's the core innovation right there. Instead of a centralized web of banks verifying everything, you use a decentralized public ledger, the blockchain.
So you're just moving value directly from your digital wallet to their digital wallet.
It's like sending an instant digital IOU directly to them without having to go through the post office.
And that change in structure, well, it results in blistering speed. Wires take days.
Crypto settles in minutes. On a network like Ethereum, it's maybe under 5 minutes. And with something like the Bitcoin Lightning Network, we're talking, well, it's almost instantaneous.
And the cost reflects that efficiency. Instead of multiple banks taking a cut, you've just got a single network fee.
Right. And that fee is usually just cents or a few dollars. It rarely goes over $5 for the whole thing. Compare that to the 6.5% average, and the savings add up fast.
Okay, but here's the pushback. I can hear the listener now saying, I'm not sending Bitcoin. I don't want to send $500 and have it arrive worth $400 because the market crashed. How do you solve that volatility?
And that is the elephant in the room. The solution is the stablecoin. This is what makes crypto actually viable for remittances.
So things like USDT or USDC.
Exactly. They're pegged one-to-one to a stable currency, usually the US dollar. This completely eliminates that volatility risk during the transfer. There are a few different kinds: fiat-backed, crypto-backed, and so on.
And we're seeing real evidence this works. In some key corridors, like the U.S. to the Philippines, using stablecoins has dropped fees from around 6% to nearly 1%.
It's transformative, but, and this is a big but, we have to be honest about the complexity.
Right.
While the transaction fee itself is low, other fees can stack up. You might have a fee to buy the crypto in the first place, then the network fee, and then a fee for the recipient to convert it back into their local currency.
And beyond the cost, there's just the technical hurdle. The traditional system needs a bank account. The crypto system needs, well, know-how.
That's the major hurdle. Your recipient needs reliable internet, they need access to a local crypto exchange they can trust, and they have to know how to manage their digital wallet.
Which means protecting their private keys, their seed phrases.
Which is basically the master password to their entire savings. If you lose that or someone steals it, there's no bank you can call. The funds are just gone. That level of personal responsibility is a huge leap for a lot of people.
Let's talk about financial inclusion for a minute, because this is often pitched as crypto's greatest benefit to society.
Right, the idea of banking the unbanked.
We mentioned the 1.4 billion unbanked adults, a huge number of them in Africa and Southeast Asia. For them, a digital wallet on a phone is their bank.
That's the theory, and the potential is enormous. I mean, banks have historically failed to reach rural or low-income areas. Crypto just sidesteps that entire infrastructure. All you need is a phone and an internet connection.
But I have to push back on that a bit. If I'm in a rural unbanked community, sure, maybe I have a cheap smartphone. But do I have reliable internet?
Fair point.
Do I have the literacy to manage a private key? And is there a trustworthy local place to convert my USDC into cash without getting ripped off? Isn't walking to a known Western Union agent, even if it's a long walk, sometimes just safer?
That's a very real-world challenge. The jump from unbanked to crypto-enabled is not a single step. It requires several technological and educational leaps at once.
But we are seeing adoption speed up, right, in those high-traffic corridors where the old system is just so painful.
We are, absolutely. Look at the U.S. Mexico corridor. That's $68 billion in 2024. Digital platforms now handle 35% of those transfers. They're using things like Ripple's XRP or just peer-to-peer platforms with USDT.
What about other places?
Europe to Nigeria is another big one. Nigeria got $25 billion last year, but traditional fees are 4 to 7%. And because their local currency is depreciating.
Ah, so stablecoins offer a way to hedge against that.
Exactly. It protects their money and reduces costs. Globally, crypto remittances are still a small slice of the pie, maybe 3 to 6%, but in places like Nigeria, P2P crypto platforms handle something like 80% of all crypto transactions. The local reliance is very strong.
And this isn't just about individuals. There's a geopolitical angle here, too. Nations like Russia and China in the BRICS bloc are actively exploring digital currencies, a digital ruble, a digital yuan.
Or just using stablecoins to build financial rails that exist completely outside of Western systems like SWIFT. It becomes a matter of national financial sovereignty.
Okay, that shift from geopolitics down to user-level security is so important. We've talked about the speed and cost benefits of crypto, but with great decentralization.
And comes great user responsibility.
Right. Let's talk about what happens when things go wrong. In the wire transfer system, you have bank security.
You have verification, traceability, dispute processes. If the bank messes up, they're generally liable. But the system's biggest weakness is you, the user, through social engineering.
Like those business email compromise scams where a fraudster tricks a company into wiring money to the wrong account.
Those cost U.S. businesses billions.
So when we switch to crypto, the security model just flips completely, doesn't it? The blockchain itself is secure. The problem is the user.
The problem is the user. Crypto transfers are irreversible. If you copy and paste the wrong wallet address, that money is gone forever. There is no central help desk to call.
Your security is entirely on you. You have to protect those private keys. And we've seen massive institutional failures too, right? The FTX collapse.
Over $1.8 billion in losses. Or classic Ponzi schemes like OneCoin, which took people for $4 billion. These risks exist because the system is permissionless.
So practically, what are the best practices for people to protect themselves?
For wires, it's about verification. If you get an email changing payment details, pick up the phone and call a number you already know is legitimate. For crypto, it's all about user diligence.
Two-factor authentication, for starters.
Always. Double-check wallet addresses. And for storing any significant amount, use a cold wallet.
Can you just quickly explain what a cold wallet is?
It's a physical hardware device that looks like a USB stick. A Ledger or a Trezor are common brands. It stores your private keys completely offline, disconnected from the internet.
So it can't be hacked remotely.
It's the gold standard for security.
Yeah.
And finally, we have to talk about taxes, specifically the IRS in the U.S. This is where crypto adds a layer of complexity you just don't get with a wire.
Right, because the IRS doesn't see it as currency.
Exactly. The foundational rule is that virtual currency is treated as property for tax purposes.
So what does that actually mean for someone just sending a remittance? What are the consequences?
It means you might be triggering a taxable event without even knowing it. There are 3 main triggers. One, obviously, is selling crypto for U.S. dollars. That's a capital gain or loss. 2, getting paid in crypto for a service is ordinary income.
And the third one is the real surprise for most people.
It is. The act of using crypto to pay for something triggers a capital gain or loss. The IRS sees it as if you first sold the crypto and then used the cash to buy the item.
So if the Bitcoin you used to pay for a subscription went up in value since you bought it, you actually owe capital gains tax on that little transaction.
That is the hidden complexity, which means the big takeaway here is documentation. You have to keep records of every single transaction so you know your basis, what you paid for it, and how long you held it.
Okay, so let's try and wrap all this up with the most actionable advice for you, the listener.
I think it starts with knowing your recipient. Do they have a secure bank account? Or do they have the tech skills and the infrastructure to actually manage a crypto wallet?
Next, you have to watch the clock. If timing is everything, 24/7 crypto is your answer. If you can wait a few days, bank wires are predictable.
And please, start small, especially with crypto. Test the system with a tiny transfer before you risk a large amount of money.
And finally, documentation matters no matter which system you use. Keep all the receipts, confirmation numbers, screenshots. It makes solving problems or doing your taxes so much easier.
Yeah, our bottom line is this. Traditional wires are still the best choice for those really high-value, critical transactions. Buying a house, a large business payment, where that bank security and dispute process is paramount.
But for frequent, smaller transfers like supporting your family every month,
Crypto, specifically stablecoins, is the clear winner. The savings from the speed and the low fees just add up dramatically over time.
and this whole market is converging so quickly. We're seeing huge players like MoneyGram, which was a traditional giant, and exchanges like Coinbase integrating crypto remittance options right alongside the old methods.
Indeed. The competition is forcing everyone to innovate, to try and merge the safety of the old world with the speed of the new.
Which leaves us with this final provocative thought for you to consider.
Hmm.
If these major financial companies successfully build bank-level security and customer service on top of the blockchain, will the choice in 5 years be less about which system to use and more about just which user interface you prefer to move your stablecoins across the world?
Something to think about.
Absolutely. Something to think about as this critical piece of global finance continues to evolve.